Howdy, Jacob here. Today we're looking at ACI Worldwide software industry, 3.6 billion market cap on 4.4 billion enterprise value. Founded in 1975, it looks like they develop, market, install, and support a range of software products and solutions for digital payments. Their growth has been pretty small, probably low to mid single digits from 2014 to now. Return on invested capital in the mid single digits, so nothing to brag home about. Operating margin is higher, but gross margin is lower. Sorry, gross margin is a little bit lower. Operating profit, though, margin is up. Balance sheet shows 164 million cash on hand with 964 million debt, 74 million short-term debt. So you got about 1.3 billion in total debt on 164 million cash. That 1.3 billion in relation to their 5-year average free cash flow of about, what should we say, I guess 180 is maybe six to seven times their 5-year average free cash flow. So they do have a significant amount of debt, not necessarily something that's a huge negative due to the fact that only 74 million of it is due the most recent year, and they can either refinance that or definitely pay it off with their cash from operations. But that is going to hinder their ability to grow and give money back to shareholders due to the fact that when debt gets due, there's two things you can do with it. You either pay it off. Well, I guess you could pay it off, refinance it. I guess those are the two things. So if they pay it off, obviously that's money that the business made that's not going to you as the shareholder. It's just making the business a safer business by deleveraging. And there's a spot where that's a good idea. Obviously, right now would be a good idea, but it is going to dwindle their ability to reinvest back in themselves, because you reinvest back in yourselves with cash from operations. You give money back to the shareholders through share repurchases and dividends through your cash from operations. And if you're using half of that money to pay down your debt, then that means really only half of it is going to you. And yeah, there's going to be a time where the debt is in a good situation. It's not too levered, and it's going to go back to, maybe 90 to 100% going back to the shareholder through some aspect. But debt pay down is really just deleveraging and making the company safer. It's not necessarily increasing the value very much. And so here, I think I'm ready to make some assumptions. I'm going to say maybe 4% and then 13 because, again, a little bit levered. They have 16% return. A little bit levered. They're, not most fantastic business ever. I mean, 50% gross margin is very good, and low double digit, low teens is still fairly impressive operating margin, but not very good return on invested capital. And in the near term, they're probably just going to be paying down debt with a bit of their cash from operations. Margin side, we are seeing free cash flow quite a bit higher. Maybe let's do 11 share repurchases. 1% would be about $36 million. And 1% to offset stock-based compensation, you're looking at about $60 million. If they were to pay down about $70 million and $60 million, that's about $130. That's a pretty substantial amount of their average 5-year average free cash flow, leaving just a little bit to reinvest, make acquisitions. But I'm probably still comfortable with that. So what I did with what I said there was just you're projecting out the use of cash flow, right? So they don't pay a dividend. I'm not going to say that project them to pay a dividend. They have been buying back shares, but 1%, at least at this moment, would be $36 million because you're just taking 1% of their total market cap, plus your stock-based compensation, because you have to offset what gets issued to the owners and the higher-ups of the business. And so if you offset that, you're looking at about $60 million. And then also, let's say they use about $70 million a year to pay down that debt. Again, that's just a fugazi number, but their current short-term debt is about $70 million. So let's just say each year, $70 million. If 200 becomes due, they'll refinance $130 million of it, pay off 70. These are all just assumptions. This is where you're using your head on what they've done in the past, and then also what you want them to do, and combining the two to get to your final result. And that leaves, 130 million in total, or that's 130 million in total, leaving maybe 20 to 40 million of their 5-year average free cash flow left to make acquisitions, to be able to grow at this type of rate, to reinvest, to be able to get these types of margins and such. And so to me, I feel pretty comfortable with these assumptions, and it's just looking very expensive. Again, a company that's not an amazing company, I'm going to want to get pretty cheap. And right now, I don't see it being the case. But anyways, hope you enjoy the video. Have a great rest of your day.